Recently in the stock market, we've seen a trend of investors getting out of stocks and into cash. In fact, there is more cash held today in money market funds than there was in the great financial crisis in 2008. This means one thing, that investors are concerned of the stock market being in a bubble. In 2008, we had the housing bubble where a lot of people lost a lot of money. In 2000, we had the technology bubble. Again, a lot of people lost money. And what investors want to know today, 2021, are we in another one of these bubbles? She firmly believes that we are not in a bubble. Unlike the opinions of other famous investors, she thinks that the market justifies the current price levels. And the key reason behind this is because of future growth. As she said, the seeds of this growth were planted way back in 2000. That's where we started developing technology, learning the basics of computers and phones and the internet, and building the base of businesses around that. And as you heard in the clip, she thinks that investors predicted this too early. And that's why we saw the technology bubble collapse in the year 2000. But now the seeds have grown into something stronger, where the businesses now have the base to start to leap and grow in the future. She thinks we're going to be seeing a lot more potential Amazon-type growth businesses over the next 5, 10, 15 years. And she believes because of this type of growth, the current prices are justified in the markets. But also you've got quite a lot of investors, particularly institutional investors, who say Ark's strategy worked well during the strong bull market that we've had, but they don't think it's going to work as well in these current market conditions. You know, if we take a look at some of these big businesses of the past, and by that I mean the ones that have failed, they failed due to what Wood calls creative destruction. Blockbuster used to be a movie and game rental giant back in the day, but you don't hear of them anymore. Why? Because Netflix innovated so you can watch movies online straight away instead of having to go to a store and hire it. Netflix innovated and it left creative destruction of businesses like Blockbuster in its wake. Toys R Us, do you remember how big that was back in the day? Now they're filing for bankruptcy. Why? Because Amazon innovated and now with a few clicks you can buy whatever toy you want. So the point Wood and I are making is that when innovation comes, destruction is left behind. This is something that people often forget. And according to Wood's prediction, she said that 50% of the S&P 500 will be impacted by creative destruction. Some of these giant companies that have been built on the current system are at risk in the future because we all know how quickly the future changes, and if you have big businesses that can't adapt well, they'll end up melting away. And this is why Cathie says all of you who have been criticizing my strategy might want to think about your own strategy and how will it work in the future. You know, are you sure that Ford or Toyota will have a strong business in 15 years with the rise of EVs? Are you sure Disney will be strong with the rise of Netflix? Will Intel be strong with Mac's new M1 chips being used instead? These are the questions that regular institutional investors will need to ask themselves. Because one of the strategies that a lot of these institutional investors use, as well as the algorithms used, is to focus on the traditional value type stocks. Because the thing that every value investor needs to watch out for is something called a value trap. A value trap is a stock that seems like it's going for an amazing price. It has a low price to book value, it pays an amazing dividend compared to the price, and on paper all is well. But as Wood warns, a lot of these type of stocks are not going to do well in the future, in the modern day era. They pay their earnings out as dividends instead of reinvesting in the business and innovating. Then you get new highly motivated companies who reinvest all of their earnings, like Tesla, and they disrupt the market. They leave creative destruction in its wake. Cathie Wood's big warning is to not invest in these type of businesses that are going to get disrupted. Instead, invest in the disruptive stocks. That's what she's been doing anyway. And she particularly warns about retail, financial services, and the energy sector. She said online retail currently makes up roughly 20% of total retail sales. So 20%, that's 1/5, right? But if you look at S-curves, where does the sweet spot occur? It starts around 10, 15, 20% market share, and that's where they take off. People are becoming more and more comfortable buying things online. That 20% of total retail sales is going to be a lot more in the future. So retail, watch out for stocks in that sector that aren't innovating. She also warns about the financial sector and energy, which have had a really strong run lately. Cathie thinks, and I agree with her on this point, that the future of energy is renewable energy. I think we all know that. No need for oil, no need for gas, but use the sun, use the wind to power this world. And companies like Chevron, Exxon, even Ford, if they're not innovating, they're gonna get wiped out. The question on every investor's lips is how long will all of this take? Cathie clearly thinks that it's going to hit these businesses quicker than some people may think. So maybe this bubble is in different areas to what some people may suspect. Maybe the bubble is more in the energy, traditional retail, and financial sectors of the economy. This little bubble thing, which a lot of investors seem to be concerned about. And we can see this with how much money people have moved into cash.
I was surprised to see that cash in money market mutual funds, now maybe there's a technical explanation, but I don't think it can be this big, is higher now than it was in 08-09. It had started to come down and now it's moving back up again. And I think this makes sense because, as I've mentioned many times, the equities have seen outflows pretty consistently since 08-09. There's been a flurry here and there, but pretty consistently. Fixed income has seen inflows. Cash is part of fixed income. These last 2 weeks probably has renewed the decline in equity outflows, and yet at the same time potentially a decline in fixed income, especially long-duration fixed income funds. What do you do with that? You put it into cash. So that's very interesting. The cash is building on the sidelines, and we do believe there is going to be an asset reallocation. You could see it towards stocks and bonds away from cash.
Now, having your money in cash is of course a sign that you're worried about a potential market crash because you've moved your money away from stocks and into cash. Surprisingly today, there is more money in cash than there was back in 2008 before the massive financial crash that we all saw. This means one thing, it means investors are worried. But as you saw in the clip, Wood's sentiment is that we're going to see a bit of a reversal away from cash and back into bonds and stocks in the future. She thinks this because she doesn't believe that the market is in a bubble at all, especially those innovation type companies, the ones that her fund, Ark Invest, primarily owns. So she disagrees with a lot of other investors who are braced for a crash with cash.
Yeah.